What's going on, guys, and welcome back to another video. So in today's video we're going to discuss 5 companies that I'm currently building up quite a large stockpile for that I'll continually buy on the dip. But before we get into today's video, I just want to say thanks very much to the 168 people that have currently viewed my latest video. Again, 168 views is nothing to most people, but it's a lot more than what I usually get, so thanks very much. And as always, if you're new around here, please consider smashing that subscribe button, as we're currently on 354 subs and our next goal is to get to 400. So with all that being said, let's dive right into my Trading212 portfolio and discuss the 5 companies. So currently we can see here that my current overall value of my Trading212 portfolio is sitting at about €4,350. I have about a further €2,000 sitting on the sideline as of now, for when the 5 companies that we mentioned today drop in value to improve my dollar cost averaging, as I feel these companies are very long-term buys and are definitely companies that everyone should hold in my own personal opinion. The companies will be in the communication services sector, the consumer staples, the ETF sector, financial sector and healthcare. So I have a kind of vast array of different companies for you to have a look at yourself. It is also just worth mentioning that the 5 companies that we will discuss are more kind of safe options and are more blue chip companies. So if you're looking for kind of high volatility stocks that kind of could be hit or miss in the coming years, then this video might not be for you. But if you're looking for kind of some steady blue chip companies, then stick around. So the first company on today's list, I'm sure everybody is aware of, is in the communication services sector in the form of Walt Disney. Now Walt Disney, I currently have €206 invested and we're up about 0.58%. Overall in my communication services pie we have €515 invested and we're up just under 3%. In terms of Walt Disney, it has ticker symbol DIS and at the time of recording its share price was about $123.75. Now obviously, as I'm sure you're all aware, because their theme parks closed because of the virus, and which also meant the slowdown and lag of a lot of their new films coming out, it really did affect the share price, and it even went so far as dropping their dividend. So that kind of really did affect the share price since the 1-year chart. This time last year, the share price was about $137.96, and it had a nosedive in March down to about $85 a share. And since then, it has started to slowly recover. And in my own personal opinion, once the theme parks start to reopen and the movies start to come back out into the cinemas, the share price will really start to improve again, and I believe it's going to go higher than its pre-market share price of about $150. And also, once the share price starts to improve and the theme parks etc. start to reopen, I really feel that they will reinstate their dividend, which again will attract more dividend investors and in turn bring up the share price. The company on today's list is Coca-Cola with ticker symbol KO. At time of recording, its share price was about $49.09. It currently pays an annual dividend of about 3.41% or about $1.64 per share. As we all know, Coca-Cola is one of Buffett's main holdings and one of his kind of favorite companies to hold. We can see here my communication staples pie is up 2.5% and we're about €5. In terms of Coca-Cola, we have €81 invested as of now, and it is currently up 1.56%. So again, in terms of blue chip stronghold companies to hold, in terms of dividends, then Coca-Cola should definitely be on your list. And even you could look into PepsiCo, one of its main kind of rivals as such. But PepsiCo also have a very vast array of products, probably more so than Coca-Cola, but I do kind of prefer the Coca-Cola stock over PepsiCo. We can see from Coke's 1-year chart that this time last year they were sitting at about $52 a share and even went up to as far as just under $60. And like the majority of companies had a massive nosedive in March, it went down to about $38 a share. But we can see since then it has started to recover and it is currently up to about $49. So over the coming months and even years, I really do feel there's a lot of room for this share price to go on an upward trajectory. The third stock or ETF that I will continue to buy throughout the years once it drops in value and continually buy on the dip is the Vanguard S&P 500 ETF, which tracks the top 500 companies in the US. So in terms of being able to sleep easy at night, you can't really go wrong with holding an ETF that holds the top 500 US companies. and certainly it's a very good company or ETF to buy when it goes into the red. As you know, long term that is going to bounce back. Currently, I have about €521 invested, and we are up about 3.94%. So at the moment, I don't really want to kind of disrupt my dollar cost averaging on this as such. So I'm going to wait until, especially because the elections are happening at the moment and there'll be a lot of volatility, for this to even go back to break even for my investment, and especially to go into the red. And when that happens, I'm going to have quite a large cash reserve built up to start pumping into the market. We can see here that the ticker for the ETF that I'm using is VUSA.L in terms of the London Stock Exchange. So this is in pounds. It's currently sitting at about £49.13. We can see here that its year-to-date daily return is 3.76%. In terms of its 1 year chart, this time last year was about £54, and it had a massive nosedive to about £38 in the middle of March again. But since then, it has had a strong rebound, and it currently is sitting at £49.13. So long term, I still feel this will continually go up, as it's so diversified across the top companies that I can't really see it fluctuating up or down, for that matter, a lot. But it's definitely a safe investment to hold, and I wouldn't recommend having a massive portion of your investments in ETFs, because as I said, they only go up about 10% on average a year. So it's kind of good to have some single companies as well to try and improve your overall return annually. The fourth company that we're going to discuss today is in the financial sector in the form of Bank of America, with ticker symbol BAC. And at time of recording, the current share price was sitting at $24.77. We can see here that the forward dividend yield is about 3.04%, or about 72 cents per share, which is on a quarterly basis paid out. The reason I like this company, as you can see here, even from the 1 year chart, that this time last year they were sitting at just under $33 a share, and like majority of banking and financial sector companies, had a very bad reaction to the crash, and it went down to about $19 or $20 per share. And since then, you can see it's gone up and down over the last few months or so, and it's currently back to about $24 or $25 a share. And over the long term, I do feel that this will be a quite volatile share, which is good in a way because it is a blue chip company. So I'll be continually buying on the dip. So for example, if there is another crash on the way, well, definitely the financial and banking sector will be hit hard. So that's definitely a good time to buy even more. So it's always good to have a good cash reserve built up. We can see from my own Trading212 portfolio, I currently have about €654 invested, and we were 0.34%. In terms of Bank of America then, €125 of that, or about $150 of that, is invested in the Bank of America, which we're currently up 4.33% at the moment. So again, I don't really want to invest further here yet until I see this kind of go back to the break-even point, or even go into the red. And when that happens, I'll start to pump in some of my capital. And the fifth and final company that I'll be continually buying in the years to come, again, once it starts to drop in value or dip over time, is in the healthcare sector in the form of Johnson & Johnson. Currently, my healthcare sector pie has €550 invested, which is about $700 or so. Currently, Johnson & Johnson has €332 of that, again, which is about $400 and something dollars. We are currently down 2.92%, so it is kind of reaching the point now where I will be continuing to pump money in. I have done so over the last week or so. I put €100 in at one stage, and then another further €50 in yesterday. So that Johnson & Johnson was down about 5 or 6%. So because of that, it helped improve my dollar cost average and brought down my overall red. So it's now just sitting at under 3% down. So again, over the next few days, if that starts to go to over 3.5 to 5% down, then I'm going to start pumping in even more money. We can see here that Johnson & Johnson is traded on the New York Stock Exchange and its ticker symbol JNJ. And at time of recording, its share price was $138.37. We can see down here that their forward annualized dividend is currently just under 3% at $4.04 per share, which is paid on a quarterly basis. And again, Johnson & Johnson, like the majority of the other companies I mentioned in today's video, isn't an extremely exciting company as such, but what they are is very safe dividend companies. We can see here from the 1 year chart, this time last year, they were at about $133 a share, and had a nosedive to about $119, $120 per share in March. But since then, they've started to recover very well and are currently in the green at about $138 a share. And again, in the long term, companies like Johnson & Johnson are very safe bets in my own opinion, as they're definitely market leaders in their own sectors. So with all that being said, guys, that brings you into today's video. We went through 5 companies that I'm going to continually buy on the dip over the coming weeks and months. I have a few thousand in cash reserve built up, ready to pull the trigger when each of these companies or ETFs start to go into the red. As I said, we are currently at about 4,350-ish euro, and I want to get this up to about 5,000 before the end of this month. So that's quite obtainable, and that would mean I'll be 5% towards my overall goal of having 100,000 euro invested into the market. So if you found this video anyway helpful, or you enjoyed the video, it would be great if you can consider smashing that like button. And as always, if you're new around here, please consider smashing that subscribe button, as it would really help the channel out going forward. And also, it would be great if you could comment below, as I'm always up for anything investment or financial related chats, in terms of companies that you would have omitted from the 5 I've mentioned, or if you have any companies that you believe I should include in companies that you would buy forever and you'd always buy on the dip to help improve your dollar cost averaging in the long term. So that, with all that being said, guys, that's the end of today's quick video. I just wanted to go through the 5 companies. So thanks very much. I'll see y'all in tomorrow's video.